Welcome back to episode 5 of Finance Maths Demystified. So, what's going on today? Well, I can tell you what's been going on this week. Wild time in the stock market, AMD, Nvidia, SMCI, big crashes, big moves, a chaotic week, but that'll all be a long distant memory in the future for you guys watching this back, right? So, what's in store for today? Well, take a look. Okay, so I'm pretty excited about this one. Diversification. This is the last bit of the puzzle we need before moving on to the efficient frontier, okay? So, what is diversification? Well, it's a risk management strategy, okay? What does that mean? Well, on the surface, don't put all your eggs in one basket. You've got a portfolio. Imagine that you heard about Bitcoin a couple years ago, so you made a trading account to invest in Bitcoin and it's your only asset, maybe with some Ethereum. Or maybe you like Elon Musk and so you bought into PayPal and Tesla, right? Well, here's the thing. That's a little bit risky because, all it takes is for Elon to go and post something a little bit controversial on Twitter and bam, down goes all those prices, right? Or alternatively, Bitcoin rally, great. Bitcoin crash, your investment's gone. And if you're invested in a bunch of other coins as well, they're likely going to follow suit, okay? So the rule of thumb, spread your investments out. Diversification on the surface is about broadening the landscape of your investments. Don't just go in one sector. Don't just go in one kind of instrument. Maybe include some bonds, keep some cash on the side, okay? Consider banking, consider utilities, energy. This is what it's all about. And there's some good reason, but there are some sort of misconceptions or general rules of thumb that you've been told that aren't quite right, okay? So, one of the common misconceptions is that you achieve diversification simply by splitting your investments across different sectors, okay? That's not quite true. It's good advice, generally speaking, and it's founded on the assumption that different sectors are going to behave differently to each other, right? By virtue of being different sectors, their business is independent and their returns are likely to be less correlated, following on from the last lesson on covariance and correlation, all right? So that means that, if there's an accident in the banking sector, it's unlikely to affect the stocks in your technology portfolio, right? And if you're holding stocks in many sectors, a bad day in one sector isn't going to impact your overall portfolio that much. And that's a good thing. You're kind of doing a fingers crossed here, though. You're hoping that if you just pick some stocks in different sectors, that that's going to be the case. When really it might not be, because just for example, with the current climate, you're invested in Microsoft, okay, a technology company, but you're also invested in AMD or Nvidia, which you might classify as a technology company, but maybe it's a manufacturing company, and maybe you're also invested in SMCI or ARM, and now you're really getting closer to chip manufacturing. They're still in the technology space, but the industry might be different, and you might think, oh, I've got diversification here, but then maybe the AI bubble pops, okay? And then so maybe Nvidia goes down, maybe they stop buying chips from SMCI and ARM, and then maybe those stock prices go down too, and that's a catalyst, that's a knock-on effect, okay? So sometimes different industries or sectors can be linked depending on the sort of macroeconomics of what's going on right now in the world and the big players, okay? But it's not a bad rule of thumb, and you'll often see it shown like this. The traditional pie that says, take your sectors, take housing, energy, utilities, healthcare, finance, tech, and just split your investment equally across those as best you can. Invest in shares of companies in these sectors so that your total portfolio value is relatively evenly split, okay? That's one rule of thumb. The alternative rule of thumb is actually in the instruments themselves. You might hear people say, you want to invest largely in stocks because that's where your growth potential is, but you also want to use some bonds, slightly lower risk, but slightly lower return. You'll increase your portfolio into more bonds as you age and you become less risk tolerant, and you want to take less risks of losing your money and, lock in those returns over time as you age and grow, right? And then some portion as cash always on the side in a savings account, 6 months salary, whatever, okay? it's another expression of the same idea. It's saying, okay, spread your asset instruments across different asset types such that you have a little bit of protection in case something goes bad, right? Big stock market downturn, it's all right. You've still got some cash. You've got some bonds that are going to pay you out in the long run. So these are the rules of thumb, but they're only surface level rules of thumb, right? There's a deeper mathematical concept underlying all of this, and it's got a lot to do with covariance, right? From the last lesson, we talked about how covariance measures the relationship between the movements of two or more stocks, okay? If you have a stock that goes up and down and up, and another stock that goes up and down and up, they're going to be highly correlated, and they're going to have a higher covariance than stocks that move in opposite directions. We use the example of ice creams and sunglasses to illustrate example of two stocks that might have negative correlation and negative covariance, okay? Now, this is important because if we can fill our portfolio with lots of stocks that are lowly or even negatively correlated with each other, then that's how we know that if there's a crash in one stock, it's really unlikely to cause another stock in the portfolio to crash, or two stocks are unlikely to crash at the same time, which overall minimizes the variance of our returns and then minimizes the volatility of our portfolio. This is where the mathematics comes into play. And I want to show you two examples here, okay? So this is using the covariance matrix to optimize diversification. As a quick pop over to the other notes, this is the correlation matrix, shows you how correlated all of your different stocks are. SMCI is correlated with many of these other technology stocks here that are using AI at the minute, but waste management, right? That's a service. It's not really a public service. It's not correlated at all with the tech space. In fact, it looks negatively correlated. And then you've got some banking and energy and commerce sites, and those aren't very correlated at all. So we get this covariance matrix, but this is the correlation matrix. Remember the difference from the last episode. And we use that. And we're going to use it to construct this bottom image here. Why would we want to construct this bottom image? Well, in this top one, we've got a bunch of different stocks: Google, JP Morgan, Coca-Cola, Meta, Monster, Nvidia, Waste Management, okay? This is what it would look like if we just took an equal amount of our capital and put it into each of these and left it there from 2020 till 2024. You'd see more than a 250% return, which is great, and you'd have a portfolio volatility of 28%. A lot of volatility, right? So put the returns out of your mind from now. Just forget about what it returned. Let's look at the volatility, which, remember, is highly related to the risk, because it's great that these went up, but they could have gone down as well, and then the returns wouldn't look so great. So for this example, remove the returns, get rid of them. Just look at the volatility and think potential for risk. 28% potential for risk. Here, below it, is what happens if we minimize the volatility, okay? Well, if we minimize the volatility, we get an overall very different looking graph. It's much flatter. It doesn't have this big dip here and then this sharp growth here and this flat line. It's relatively stable and consistent growth with a volatility of... It's quite difficult to read that number. I'll have to edit in a second what it is. But this here is really only Google, Microsoft, and then a tiny, tiny bit of Amazon and Apple. And the point is, we've now got a portfolio that exhibits way less potential risk, okay? And that's important. In fact, to be specific, we found what's called the Minimum Volatility Portfolio. So what is it? It's a portfolio we hold in pretty high regard when it comes to optimization problems in finance. It's the portfolio, which is the allocation of your capital across a selection of stocks that means that the portfolio's projected volatility, based on the historic volatility, is going to be the lowest that you can get. There is no combination of money in stocks that would lead to a less volatile portfolio, a little bit more percentage in Amazon, a little bit less in waste management. No, this tells you the percentage of your value to put in each of these assets you're interested in to make sure the volatility is the lowest based on past data. Okay. So there's an important point here. It doesn't aim to be the highest return, just the lowest risk. It's the portfolio you might opt for when you're getting closer to retirement age and you're just looking for very slow, steady growth and very little potential for downside, but also upside return. So how do we create this portfolio at a high level? You begin with the historic returns of the assets that you're interested in, the daily percentage returns, okay? From that, we're going to calculate the covariance matrix. Imagine this in your head, okay? All of our assets and how they move with each other, their correlations to each other. And then we're going to use that formula that I laid out in the covariance lesson here, which is the variance of take our portfolio allocations times those by the returns of each of our stocks, okay, to get the overall weight of returns for our portfolio. And that variance is going to be equal to this allocation times by the covariance matrix times by the allocations. And we minimize this to get an answer for W, for our allocations, our weights, that will give us the minimum volatility portfolio. Now, here's where it gets exciting. Hopefully you're beginning to see that the amount of money that we invest in the same set of stocks heavily influences the expected performance of that portfolio over time. We can control the amount of risk we plan to expose ourselves to through projections. The other side of this formula is controlling the amount of return we plan to expose ourselves to, or that we're willing to accept for a unit of risk. This means we get to take the concept that we've been building of diversification and say, okay, we've got our minimum volatility portfolio. Now let's build off that. How can we begin to introduce more value into different assets in our portfolio to increase the expected return while making very minimum adjustments to the overall volatility of the portfolio? And now this is where we begin to get into concepts like the efficient frontier. We can begin to make a portfolio that exhibits the level of expected return that we want within a range of risk tolerance that is acceptable for us. Okay? And that is going to be the next lesson. Hope you've enjoyed, hope you've learned something, and see you there. Bye.